All right. Well, welcome everyone, and thanks so much for being here. We're really excited that you're here, stats nerds and stats fans near and far. Want to take a minute, as we always do, to thank our sponsors, our very generous sponsors. So shout out to Bell Bank, Bell Bank Mortgage, North Star MLS, RCU Royal Credit Union, and Supra. I know I've mentioned this once before, but I just want to say when we're at conferences and John Mosey, who's the director of North Star, when he's there, he has a whole train of people who follow him around, asking his advice on how he dealt with a merger or a vendor. So we're really lucky to have such a forward-thinking MLS. So shout out to North Star along with the rest of our sponsors. Want to just take a second to say we hope this finds you and your loved ones well and safe and healthy and not going too stir crazy. Seems like things are starting to loosen up a little bit. Want to also mention our COVID-19 resource page. And also we have something else up now, which is part of sort of the rebuilding effort after some of the recent events in Minneapolis. So I'll just show you guys lots of different stuff, evictions, forbearances, NAR guides, consumer tips, our EPD classes. I'm a little biased, but something I'm the most fond of, our local housing market updates, and our webinars. So you are here. We are all living here right now in our weekly webinars. So just a quick breakdown, quick outline of how things will go. So we'll start off with the market. We'll spend the bulk of our time there talking showings, buyer, seller activity, and then we're going to break activity down by price range, so you guys can kind of give better intelligence to your buyers and sellers depending on their price point. May reports are out. They have been out for, I think, 3 or 4 hours, so very fresh data. I'm pretty excited to share it with you guys. I don't know that we'll have time for an economic update, maybe next time, just because we've got reports out today. But if we have time, I'll touch on this briefly. If not, I'll spend some time on it next time. All right, for anyone new, everything depends on 3 things still, right? The length of the pandemic, the impact of stimulus and relief that we've done, and then the consumer response or reaction and how that drives our spending and behavior. So we've kind of got COVID pulling this way, and then we've got government, Federal Reserve, and our scientific community sort of pulling that way. Brace yourselves, my friends. Data analysis is coming. The market. Take a look at showings. So this is a rolling weekly average of daily showings. So each point on this curve represents 7 days. So it kind of moves through. It's just like our 12-month rolling average, where we kind of roll through the daily data and average it up into a week. We can really see the effect of COVID and some of the shelter-in-place orders and how that impacted our market. You'll see some blips for Easter, Passover. You'll see a blip here for Mother's Day. You'll see a blip here for Memorial Day, as well as some of the tragic events surrounding Mr. Floyd. Here's, I'm gonna go on the record here and say this is a much more interesting, maybe the most telling visual for showing activity. So let me walk you guys through this. In gray, we have 2019, right? So you guys can see, looks like showing activity usually peaks, what, end of April, early May, which makes sense because typically we see sales peak in June or July. So about a 1 month, 2 month lag there, which again, makes sense. So you do some showings, you write some offers, and then finally, hopefully you close the deal. So that's 2019 in gray. What I find so fascinating is look at where we are. We are, I don't know about significantly, but noticeably ahead of our 2019 trend, which I think is really promising. So I mentioned this last time. Can we make up this gap? We were under last year for a while. Can we stay above last year for a while? If we can make up some of that gap. I'm not sure we'll make up all of it, but already we're making up some of it because we're trending above 2019. So I think that's pretty encouraging. I think that's a pretty encouraging data point. And also just notice more broadly how, blue has pretty much synced up with the gray trend line. They're kind of mimicking or mirroring one another. A few other interesting tidbits, kind of see Memorial Day here. How about here? 4th of July here. How about here? What is that? Labor Day here. What's going on over here? It looks like Thanksgiving over there. And then finally the Christmas and New Year's holidays as well. So pretty interesting. You know, when we go down, we kind of surge up and then kind of get back on track. We go down for the holidays and then we kind of make up a little bit and then we're back on track. So kind of some interesting trends here. You know, in 6 months from now, it'll be really interesting to see exactly how this blue, you know, kind of plays out. So really interesting visual, at least if you ask me. All right, we're going to speed through some of this. I think you guys are pretty familiar with how we think about this and kind of break things down. So we've got our affordable segment, typically younger, sometimes first-time buyers, sometimes move up, sometimes single people, sometimes married people, sometimes kids, sometimes not. But a lot of those folks work leisure, hospitality, restaurant, and retail jobs. Not all, but those who do, you know, I don't know if I can say the majority, but a good chunk of them unfortunately lost their source of income. And if you can't work from home and you lose your income, you're probably not going to be as likely to buy a home, at least not for the time being. Fast forward to our luxury segment. Here, you know, we think a lot about stocks. A lot of high net worth folks shopping in the luxury brackets, have a lot of their wealth in equities and in stocks. And you know, while we've come back from the lows in you know, in the Dow and S&P, we're not all the way back. There's still some volatility, and that can affect that can affect confidence. So there's this wealth effect. When we feel wealthier, we tend to spend a little bit more and are a little bit looser with our wallets. Middle market, right? Kind of between luxury and affordable. These are just boring, steady Eddie salaried professionals who are able to work from home. Excuse me. So take a look at April, guys. Just a quick visual. Leisure and hospitality, by far the most substantial losses in jobs per the April report. Yeah, I guess we'll skip the others for now. We've talked about this as well. So look at, well, this is March. I haven't found a similar graphic for April or May, but just take a look at you know, where the job losses were mostly felt. Blue, right? Folks with a high school education and under. These are good people. You know, there's no judgment. Not everybody can do a 4-year or 2-year program. That's okay. But I think the challenge is the job losses impacted the folks who can least afford it, who can kind of who aren't really positioned to deal with it, and many of whom do live check to check and who don't have 6 months of savings. So you know, that can obviously cause some challenges. All right, so this is new. I really like how this breaks things down. So the percentage of people saying that this has happened to them or someone in their household because of coronavirus. So been laid off or lost job, 28%, plus 33% who had to take a cut in compensation. Breaking things down by demographic and racial and age groups, right? Our Caucasian group, 24%, our Black community, 32%, our Hispanic community, 41%. So we can see that there's some disparate impacts here. How about by age cohort? Younger folks, a lot of first-time buyers here. There are some first-time buyers here. There are also some third home buyers here. So here's our folks, you know, 24, 25, college grads, early, you know, young adults kind of settling into the post-college life. So those folks, 35%, you know, versus 30, 28, and 17. Again, bachelor's only 21, some college 30, high school or under 32%. So again, we can really see some of the disparate impacts across our well, this is national, so across our nation, but also across our Twin Cities community as well. First-time buyers, you guys have seen this one. I won't spend a ton of time. Just understand that first-time buyers have been a little bit of a shrinking share of overall sales just because of prices. As prices march higher, you know, some of those listings are a little bit out of reach for especially first-time buyers. I always like to point out 50% when the market was on sale in 09 and 2010, actually half of buyers, 5 in 10 buyers were first-time buyers. So pretty interesting there. Yeah, there was a time when you could be 30 years old, right? When home prices were on sale. So the median age was 30. Half of the first-time buyers were above, half of the first-time buyers were below that level. Uh, as prices rise, we're having to wait a little bit longer to buy a home, a little more savings. Maybe some folks are thinking 20% down so they can skip the PMI. I think I made this joke once before. You know, you see people getting older. Most people age about 12 months each year. I get 18 months older every year. Anyway, so here we are. Millennials are living through their second once-in-a-generation collapse, still giving each other elbow bumps. And then millennials are kind of waiting in the wings for their opportunity to enter the market if one presents itself. So all this gives us a theory. When we talk about the affordable end, the luxury end, and what we're calling the middle market, this gives us a theory that these mid-market ranges could be performing the best. Uh, this might be one of my favorites. It's at least in my top 5 just because of how it shows the trend and just how well it captures, you know, what happened and what's been happening. So end of March, everything down, right? Across the price spectrum, everything down. Looks like luxury down a little bit more than affordable. And then fast forward, some up, some down, some up, some down. One more week, or I suppose a couple more weeks, and then we've got everything sort of surging higher, right? 50%, some 80, 90% even. Overall, 40%. So we were down 22%, then we were up 0.7%, then we were up 40%, and now we've kind of settled into a pattern where we're up about 9%, so 5 to 10%, much more sustainable than 40%. But remember, this was bouncing off of these lows, right? So everything was down, then we kind of had a mixed bag here, and then we've really kind of bounced off the lows here and settled into a little bit of a pattern. So let's look at more recent activity. This is for that week ending 5/29. We do have more recent data that I'll get into in a moment. So change in showing activity by price point. You guys will note our only gain came in that 600 to 800,000 segment. So kind of interesting. I've sort of struggled with how to label some of these. Maybe this is entry-level luxury versus the premier luxury segment versus the platinum luxury segment, something like that. So we also saw a gain in our 500 to 600,000 range. So overall, showings down 12% for that week. But remember, Memorial Day had a lot to do with that, as well as some of the tragic events that took place. So fast forward a little bit to the week ending June 7th versus that last week of May. Pretty healthy gains. Nice to see gains in our affordable end if we have supply for them to write offers on. I think that's the challenge here. So this is pretty interesting. Never mind that, pretty much our only gain, right? Forget the 0.1%. Here, our only gainer was 600 to 800,000. Here, our only loser was 600 to 800,000. So just know that some of these segments are volatile, and sometimes, a price point that was down last week can see an increase this week. Really notable surge in million plus showings. Pretty interesting data point there. Here's our most recent numbers for the week ending June 14th versus that first week. So second week of June versus the first week. It's nice when the numbers work out perfectly. Here we do see some mid-market gains. So consistent with our theory, 400,000 up to 500,000 saw the strongest gain, up about 24% in showing. So I don't know, that's like going from 2,000 to 2,500 showings or so. So some strength in that mid-market. Again, maybe a move up, maybe that first move up. If folks are doing, a 275 or a 325 for that first home, sometimes you'll do 4 to 4.25 on the second one. Here, million plus, not up as much, and overall, we're looking at about 11%. So for those of you who haven't heard, and for those of you watching the recording, we like to mention that we have heard builders say that while showing traffic is down, it really tends to be a higher quality buyer that are just more motivated. So it's better traffic, it's higher quality traffic, better leads. So some of the true qualified buyers are still there, but some of the fringe buyers have sort of moved on. All right, we're not going to spend a ton of time on this one because it's good, but it's not my favorite. Overall showing activity by price point, we see gains, looks like across the board. Some more so than others. Looks like nice gains again in these mid-market ranges, even though they're not as much volume as our affordable ranges, we still see a nice percentage increase, versus this. So gains across the board. As we discussed last week, and this is a pretty interesting point, guys. So let me go back real quick. Even though every price point saw increases in showings, some had larger increases than others, which means you'll actually notice some price ranges can lose market share even though they had a gain in activity. So kind of interesting. And just in case you guys have to explain that to any buyers or consumers or I don't know, just so you guys are kind of aware of that. So even though most of our volume is here, we actually had declines in market share in our three most affordable segments. Looks like we had gainers in all of the other segments over 300,000. Looks like with the exception of million plus. I'm calling that flat movement. What is that? We've lost 0.04% of market share, 1.57, all the way down to 1.53. So nothing to write home about there. We've been discussing over the last couple of months, just a reminder, we like to think about this notion of a life cycle of a listing. So first, the listing is new, then it's active. First, a buyer gets a pre-approval letter, then they go to showings, then they write offers and go under contract, and then they hopefully, or I think 96 or 97% of the time, they will hit the closing table finally. So why does this matter? Why do we care about this? Well, if we want to look at what active listings are going to do tomorrow, let's try to have a look at what new listings are doing today. Assuming buyers don't absorb all of them off the market, we can kind of get a little bit of a leading indicator on the supply side and also on the demand side of our equation. So you want to forecast closings, look at pendings, look at showings, and look at mortgage applications, pre-approvals, things like that. And there is good, there are some good data on that. Alrighty, so here's our most recent weekly report. This is the weekly market activity report, straight from our website, mplsrealtor.com, and we will visit some of our reports that were just released today. Current activity 2020 in blue, year ago 2019 in dashed gray. You guys can see the declines that began about mid-March. You can also see some of the recovery from COVID. We're not all the way back, and then lately, you've seen a little bit of volatility, a little bit of a downtrend. We're still above our lows. Ideally, we can stay above those lows. No guarantees there. Anyone who says they're certain of that is lying to you. But what's interesting is we are mimicking more or less last year's trend. So last year saw this dip around Memorial Day. So I think some of this is just attributable to the holiday. Again, on the demand side of our equation, you guys can see, look at how close pendings are, signed contracts are from 2020 to 2019. We are really close. And the trend, we like to say the trend is your friend. And the trend here is really close. Let me just hop back to sellers. This is a pretty, well, I don't know if I'd call it a wide gap. We're only talking, well, it's a noticeable gap. It's definitely a bigger gap than the buyer side. So, we saw declines in buyer activity also mid-March around the stay-at-home order and school closure and shelter in place. We saw those declines. We saw recovery. We kind of got back to break even. And then we really surged higher. So notice how much we've kind of closed this gap. And that's really nice to see. Again, you need product for these buyers to write offers on. So I still think we have challenges on the supply side, as we know. Alrighty, these next two are also in my top 5 or maybe top 10 favorites, just because they tell such a rich story. So here we have 2020 in black here, our black trend line, and then we've got 2017, 18, and 19 in varying shades of, I guess, blue or purple. So 2020, new listing activity, so seller activity, looking pretty strong at the beginning of the year. You can kind of see this little trend as February starts, kind of have this surge. Then we kind of float, sideways. March starts, we have this surge. Then we kind of float. April starts, then we have these listings coming on. So you can see a little bit of a trend there. Again, I guess for a little while there, seller activity was looking pretty darn good for some time until, of course, the world changed, and then it wasn't so much. So we can see the impact, we can see the recovery. Look at how we are mimicking past years, which I think is encouraging. you know, guys, if we took this dip in our black trend line here, if we took this dip alone, some folks might be concerned about that. But when you look, you know, all of the last, all 4 most recent years have done that. Again, on the new listing side, we still have a pretty notable gap here. Can we hold this uptrend and hold these lows and not sort of retest or fall below these lows? I hope so. I think so. But again, no guarantees. Yeah, really hard to forecast in this kind of environment. So pending sales, again, on our demand side, first things first, guys, look at how close we are. Look at how close buyers are to the previous 3 years. So they've really closed this gap, and there was a big gap, right? Mid-March, we know when the decline started. This is pretty interesting. We actually crossed over past years. So we've actually crossed new listings since COVID. New listings, I guess one data point here, it looks like. Maybe I can do my little trick. Yeah, I guess we got one, you guys. Sorry. You know, for the most part, though, seller activity has really not kept pace with the previous 3 years. But buyer activity is flirting with those other trend lines. And I think that's, I know that's encouraging news. I think everyone sees that as pretty encouraging. I think we're more likely to keep our uptrend here. That is not a guarantee or a forecast. It's just kind of my gut. But again, it all depends on those 3 things that we discussed. All right, so this is a new one for you guys. We're pulling out some fresh material, some homegrown free-range stats here. This one is a ratio. We're looking at basically the demand to supply ratio, pending sales to new listings ratio. Think about this, guys. What happens when this ratio is high? It means that buyer activity is pretty high relative to seller activity. So, you know, the way to interpret this is a value of 90% means that there were 90 pending sales for every 100 listings. That would be a 90 to 100 ratio, or a 9 to 10 ratio. So look at this, guys. We are over 90% in 2020. What does that mean? Well, we just saw that new listings haven't quite come back, but pending sales, not all the way, but they have much more so. So you can see this year, really since, looks like the beginning of June, since, you know, I think confidence was coming back a little bit. I know it's not all the way back. All the data proves that. But look at where we are compared to the previous 3 years. I think that, well, look, the previous 3 years were about 70%, more or less 70%. So there was a 7 to 10 pending sales to new listings ratio. Where are we at now? 92%. That tells us that buyers are really overwhelming sellers. You know, and this, you know, there were some times this year where we were lower. You know, we've been higher, and now I think this is starting to look like a trend, at least a 2-week, 2.5 week or so trend. So I find this one really interesting. That's why we're sharing this with you guys today. You know, it really speaks to just how much demand is outpacing supply. All right, here's another fun one. This is week over week in a year over year sense. So this is the week 6/15 of last year versus the week of 6/13 for this year. Pretty close. You know, both will have weekends, but you know, sometimes you'll see holidays or what have you, but not this time. So change in new listings. Week over week, we see our biggest declines in affordable. We've been seeing that for a while. Here's our mid-market range, or one of them anyway, 350 to 500K, looks to be our best performer. The best of a bad bunch, I think we've been saying. You know, 3/4 of a mil up to a mil and 1 mil plus, not looking too bad. We do see some increases in new listings. You know, I don't know if that's exactly what everyone is looking for. I think folks are looking for much more of this product. But we did see that sellers, you know, seller activity didn't decline too much from this week last year to the most current week this year. How about change in pendings for that same week last year to the same week this year? So now we actually see some gains. We see 3 nice gainers. Our largest gainer is, once again, I think we are noticing a trend here. Biggest gainer, 16.33%, came by way of the 350 to 500K segment. So that mid-market, first move up, sometimes first time buyers, or first move up market, tending to perform the best. Contract activity down just 4% for $250,000 up to 350. I think that's a pretty good number. That's not down too much. Plus or minus 4 or 5% really isn't a significant change. We also see some gains in pending sales activity in some of our luxury brackets. So again, $500,000 up to 3/4, and then 3/4 up to $1 million, also showing some demand, some gains in demand on the pending sales side. But we do see a larger than a quarter decline in million plus. So sellers, only had an 18% decline. Buyers had a 26% decline in that luxury segment. All right. I might skip some of March. Let's just kind of blow through this really quickly. I want to show March, April, and May because, as we know, I think those months will be some of the most unique months for market data. Maybe this year, I don't know about ever, but surely in many years, at least since the Great Recession. So change in new listings by price point for March compared to March of this year compared to March of last year. We saw the gainers in the mid-market ranges. We saw some losers on the tail ends of our spectrum, on the high end and on the low end. Keep moving on that. Pending sales, again, biggest gainers, roughly 250 up to 500, I guess we can say, especially 350 up to 500, 30% increase in pending sales. But remember, the first half of March was looking pretty good. The second half of March, everything changed. All right, we've seen how April numbers can sometimes look a little bit ugly, and we knew they would. So April of this year compared to last year, here again, we kind of see this inverted U shape, right? We see pretty significant declines in affordable. We saw a pretty significant decline in luxury, and then seller activity only down 7% from last April, again, for 350 up to 500. Here's our mid-market ranges performing the best. Yeah, we've been noting this a little bit. Just know where the volume is, you guys. The volume is really here. Not a lot of volume here, so we can look, we can see some extreme changes. And again, not a ton of volume up here. So we see some extreme changes, but when we only see down about 7%, and that's where so much of our activity occurs, I guess most occurs here. So I think that's pretty encouraging because that's where the bulk of activity is. All right, change in pending sales. So similar story, April of this year compared to April of 2019. Most dramatic losses in the affordable end. I suppose we see some notable losses in our fledgling luxury segments and our full-on luxury segments. 0% change in 750K up to $1 million. Here again, folks, I guess minus 750K to $1 million. Our best performers were still those mid-market ranges. And just know that on the pending sales side, we also see the bulk of our volume there, obviously. We're talking 55 guys versus 1,500. 1,000, 2,000, so 3,500 in these three ranges, versus not that many on the tail ends of the spectrum. All right, so here's May. Obviously, the most recent numbers. We are not through June, so we don't have June data. But look at this, guys. So again, we see most dramatic decreases in seller activity on the affordable end. But we didn't have any gainers, but the best performer technically was million plus. So sellers of million plus were technically the most active, I guess you could say, relative to last year. Or I guess their activity declined the least. Sometimes we struggle to describe these things. So overall, down about 24%. Change in pending sales. Here it's much more clear on the demand side, which makes sense. Down not even 3% in our 350 up to 500 range. Pretty notable declines in affordable, pretty notable declines in luxury as well. Only down about 13% in May for the whole market. Let me just go back really quickly, guys. April pending sales down about 19 or 20%. May pending sales only down about 13%. So it appears as though the declines are shrinking. We cannot say what June will bring, or even July, or really any other month this year, or perhaps next for that matter. But it's nice to see these declines are shrinking. All right, let's do a quick time check, and it looks like we are at 2:30. So let's pivot, guys. I want to pivot just briefly. I want to show you guys some of our most recent reports, because those are out. So let me bring in my Google Chrome. Right on our homepage, first things first, we mentioned this briefly. Our information-packed COVID-19 resource page, and then of course realtors banding together to help to rebuild our community after the recent events. So do check those out. There's a lot of good info in there. Our calendar with all of our classes and events, not that many in-person events nowadays, but a lot of other activities going on, from classes to webinars and so on. And then again, I'm partial, but my favorite part, all of our reports. So let's just hop into, let's do the monthly indicators. That'll take us to our Fast Stats interface. Just know, guys, you can bookmark this. You can also go through our website. We like people going to the website, but just know that you can access it here as well. So let's jump right in, folks. Here you'll see May right there. Take a quick look at our overview. So like we said, we just saw this 13 to 14% decline in pendings versus that 24% decline in new listings, so seller activity. And that did turn our year-to-date figure negative, but not by all that much, because we obviously saw gains in some of the first months this year, some of the earlier months, but some of this has turned negative. Again, the declines in pendings seem to be shrinking, but of course those pendings are now transitioning into closings, and so we saw the declines in pendings from April are now the declines in May for closing. So again, life cycle of a listing, folks. It's active, then it's new, then it's active, then it's pending, then it closes. So no surprise there. Days on market, 45 down to 41. That was down about 9%. Overall for the year, we're down about 7%. So, we talked about, guys, how there's more serious buyers floating around out there. So it's no surprise that they're making offers a little more quickly. Maybe they're stronger offers because, for lots of reasons. So we tend to see home selling. We're still seeing home selling more quickly than last May. Prices still higher, 3.5% higher. It's not a big gain. In fact, I think it's the smallest gain in a couple years. So here we are, let's call it 295 versus about 290.5 for the year so far. So far this year, we've been doing about 5.5% increases. Most recently in May, we're only doing about exactly a 3.5% increase. Some of that is going to be skewed by what? How about new construction home selling? We know those are bigger. Those tend to be 2,500, 2,800, some 3,000, some 4,000 or 5,000 square feet. But a lot of the existing homes obviously tend to be 1,700, 1,800, 2,200, 2,500 square feet. So for that reason, some of those bigger sales, whether new or existing, some of those larger homes, literally just bigger homes, can drive this figure higher. If we correct for or adjust for price per square foot, which accounts for the variation in the size of homes, so here we actually see 1.2% from 162 per foot to 164 per foot. So a lesser increase in PPSF versus just MSP, just median sales price. So again, some of this is being influenced by bigger home selling. Once we correct for square footage, some would say this may be a more accurate figure. For the year so far, about 3.25%. Okay, a couple other interesting, I suppose let's dive in, especially to this one. I think this one is really fascinating. Let's just finish things up. Inventory down, month supply down as well, both by, let's call it pretty much the same amount. 2 months of supply, still a very much a seller's market, a very tight market. So let's look at this one real quick. And I've actually got another chart to show you guys, but I do want to show you I really want to show you percent of original price. There's your PPSF, 5, 3, 5, 3, 1 1/4. So, noticing a little bit of a change there. Yeah, value index, yeah, that's not my favorite. We can talk about that later. Percent of original list price received. So let's just pause here for a second. So take a look at this with me. So this is current, this is prior year. So we had some declines in June of last year. I think that had to do with rates and a couple other factors. And then we got back to gains once rates kind of went down at the end of last year. We started to see some gains in that ratio of sold price to list price. So what percent of original price are sellers yielding or receiving? So look at this. This is really fascinating. We've had gains from last September all the way through April. And then we see an interruption. We see a disruption. Something has changed here, right? And it's not like we've gone from plus 0.5 to plus 0.3 or plus 0.2. We actually went from plus half to almost down half, from 100% last year to nearly 99.5 this year. So there's your 0.4, from 100 down to 99.6. So this has been pretty high, you guys, right? Look at this 100% mark here. I don't know if we quite show that. Yeah, there you go. Over 100%, 100 and 1/3, 100.3%. There you see that, and looks like we just barely touched that in. Well, sorry, this is prior year for June, which is 2018. So this is actually a 2018 number. So that would be right here. So pretty interesting data point, guys. Things seem to be trickling down a little bit, or I should say softening a little bit. What's interesting is, again, this seemed to be a trend before COVID. So lower highs and lower highs again. So I don't know how much we should read into, well, it's interesting to think about how much we should read into the impact of COVID versus, perhaps other more organic changes in the marketplace. And, while we're on that topic, let me just switch to InfoSparks. I think you guys are going to find this really interesting. Let me do pending sales. Let me break things out by property type for us. I'm going to shut down my two others. Let's see, condos. Sorry. Wait a second. There we go. Percent of original. This is what I wanted to look at. So some people say when the market catches a cold, sometimes the condo segment can catch pneumonia or a whooping cough. So look at condos, you guys. I don't want to move my mouse near it because the labels kind of block it out. Look at the condo trend on that ratio of sold price to original list price. Notice here, I guess I will mouse over. Notice condos 99.5 in July of last year, down to 99.4, and then by January of this year, down to 99.3. By March, down to 99.2. And remember, first half of March was still pretty good. Second half was obviously challenging. So if you look at this, we've actually seen a little bit, we've seen some early signs of weakness in the condo market. Nothing like this where condo sellers got 89.7% of their original list price. So they basically got 90%, had to take 10% off. So you're selling a $300,000 condo, or you're listing a condo for $300,000, you can expect offers at $270. At least you could back then. Here, still at 99%, that's pretty good, but it has come down from 99.5. The sky's not falling. This is not the end of the world, but I think it's really interesting to note that condo market started to soften about a year ago, well before COVID, even well before COVID arrived overseas in any other country. We started to see the condo market change. So I think that's really interesting. Oops, sorry. Let's hop back to our reports here. Let me go back to fast stats. Let's just hop into a couple local market updates just so you guys are aware of how those work. We were just on monthly indicators here. You can look at the weekly as well. I just pulled out some, I just teased out some of our weekly charts in the slide deck. And now let's look at local market updates. So we've got all of our 16 counties in the metro. What should we pick on? Let's pick on Dakota County. Maybe let's do Lakeville today. Okay, So Lakeville seems to be mirroring the metro pretty closely, down about 16%, down about 20%. Fairly indicative of the metro, fairly reflective of the overall trend. Median sales price up actually less than the metro. Remember, metro was 3.5. Lakeville only about 1%, from 381.5 to 385. Lakeville homes taking 47 days. Lakeville sellers getting 99.1% in an environment with 2.3 months of supply. Let's close Lakeville. Let's just hop into Eagan, a little bit closer into, I don't know, maybe some jobs in St. Paul or what have you. Interesting, sales down pretty notably, down 40%. Seller activity did, again, kind of mimic the metro. What's happening here? Yeah, price is about 3.5%, so that's pretty consistent with the metro. Wow, sellers here still yielding over 100% of their original list price, and that actually rose. So Egan's still pretty strong in that way, but it does look like sales took a dip, which suggests pendings took a dip in April, obviously. Look at how tight this market is, guys. 1.3 months of supply, a very, very tight market. 24 days. I can't remember what Lakeville was. I wonder if we can just cheat really quick. What was Lakeville? Right, 47 days. Some interesting differences there. Let's just do one more. Let's check out Scott County. Should we do Savage or Shakopee? Let's do Savage. Pretty consistent here. Prices, median actually down, all right, by 1,000, by maybe $1,200. So nothing to write home about there. Down about 0.5%. 155 a foot, 99.5% of original. 32 days, so just about a month. Inventory down, and also a fairly tight market. Not as tight as Egan, but tighter than Lakeville. So that's Savage. All right, let's hop out of the local market updates. Let me pivot. Well, let me just do a quick info sparks, just in case you guys aren't familiar with it or you need a little refresher. So let's just take a look. We were already playing with the condo data and showing how some of the changes that we've seen in the condo segment are kind of predate COVID. We showed Lakeville and Savage, and so maybe we should talk about new construction real quickly. Well, percent of original is not the best metric because, of course, builders are going to do 100%. They don't want to shoot themselves in the foot by accepting less than full price, and then that becomes a comp. So you'll see those guys have been at 100% much longer than existing or previously owned, which only got to 100% just about 2 years ago, versus new construction that was at 100% 7 years ago, 7.5, I guess. So what builders do instead is they'll just throw some bonuses in, a bonus room, finish the basement, throw on a home office, or I don't know, a deck or something like that. So I guess there is some interesting data there. Let's look at new listings, and here, you guys, I'm just going to switch to bar charts because I think it does a better job. Well, it seems to do a better job of showing the change and kind of showing the last 3 Mays. So be careful here, guys. We're looking at a rolling 12-month. If I just want to look at monthly, this is just the month of May. I've got the month of May. So down 0.2% on seller activity. So builders, pretty flat, guys, 935 to 933. I'm going to call that flat. Our decline really came by way of existing or resale, down about 0.25. Take a look at pendings. Again, kind of remarkable stability in new construction. Pendings down about 14%, which we sort of saw, versus 20% for April. So again, May declines in demand are shrinking, and that's encouraging. Days on market. So yeah, new construction obviously taking longer, 42 days versus 16. Guys, I can't emphasize this. This is about 2 weeks, and this is a median, which means half of the existing homes take longer than 16 days to sell. The other half sell in less than 16 days. So a remarkably fast timeline there. Absorption rates, let's place your bets, folks. I'm betting 5.1, maybe 5.2 for new, and I guess I'll say, I'll go 2.1 for existing. Let's see how I did. Okay, a little overestimate on the existing side, so 1.7 versus 5.1. So new construction technically in a balanced state. So 5 to 6 months is a balanced market. Think of that as a neutral market or market, price equilibrium, or a balanced market between buyers and sellers, where demand isn't overwhelming supply and there's not too much supply relative to demand either. So a balanced market here, but very much a seller's market, very much an undersupplied market. All right, let's take a look at the money thing, the pricing on these different products. New construction, 417,000 versus existing 285. No wonder, guys, so much of the demand is here. No wonder these are selling more quickly. They're simply more affordable. All right. For my final, maybe another 10 minutes, and then we'll take some questions, maybe 5 or 10. I do want to skip a little bit, guys. So I've done something new, as I mentioned, and here we're actually looking at May. But we've put this in context with the last 17 years. So we go all the way back to 2003. You guys can really see the run up in seller activity heading into the bubble, and then the decline after, into the Great Recession. We've been pretty stable, pretty flat. We're nowhere near these levels, and I'm not sure we should be. This was definitely an oversupplied point in time. Not a lot of gains here, pretty flat, but I suppose on a slight uptrend, and we can really see the impact of COVID here, down 23%. We seem to be accelerating, right? Plus 0.4, plus 1, plus 0.8, 3, 3, and then down 23. How about on the pending side? We can really see the run up into 05, 06, the downturn. What's going on here? You guys remember that tax credit, that first-time homebuyer tax credit? So we saw a little bit of a bump here, and then we had to find bottom, kind of find that floor. Demand has kind of been floating a little bit downwards. Not a lot, minus this May, minus last month. But we believe this is due to inventory constraints, supply constraints. Were we to have more listings on the market, and assuming rates are cooperative between, 3.5% to 4%, maybe 3.5% to 4.25%, I do think we could see gains in pendings. All right, so closings, very, very much a similar trend to pendings. Let's kind of pick up the pace a little bit here, guys. So here's our 16 days on market. By the way, that's a median, not an average. So you'll see sometimes both used, or I should say different metrics used. 122 days on the market, guys. Long time in 2008 compared to 16 days. Big, big differences there. Original list price. So sellers drove list prices up 3.5% to 320,000. Again, we can see the trend. Please pardon some of my overlapping here. I feared if I went any smaller, my aging eyes wouldn't be able to see them. So we can see the run up, the downturn, and then the subsequent recovery. So this is interesting, guys. List prices up about 3.5%, and sold prices up also about 3.5%. So sort of in line with one another. Pretty similar trend. We've been marching higher. 8%, down to 5, now down to 3. So perhaps these increases would have slowed, or I guess the rate of increases. So we can still be increasing, but at a decelerating pace. You can still be moving forward on the highway, but you can go from 60 miles an hour down to 50 and still be moving forward, but at a slower rate. So perhaps we're seeing that happening. PPSF, I won't spend a ton of time here, 150 up to 155. We saw a similar 3% gain here. Here we go, guys. I even put a star on it for you. Just May, percent of original list price received. That ratio of sold price to original list price. Even in the height of the bubble, 99.3%. Well, I don't know if that's the height of the bubble, but it's the highest we had in that bubble time, in that era. You guys can see we've been over 100%, then 100%. Now we are 99.6. So there's our minus 0.4. I thought I saw some activity on chat, so let me just take a quick pause and give that a check.
Yeah, David, I didn't see the initial question come through, so I was just following up to find out why not Farmington in relation to.
I think Leanne is on the planning commission down there, so she might be biased, but
oh.
okay. Okay, Leanne, we'll look at Farmington. Oh, she's funny. Okay, guys. So take a look at this. So again, we had that 2010, that tax credit. Look at the impact there. But here again, look at this, guys. We actually saw a decline into 2019. So from 2018 into 19, we did see a decline there. So perhaps we would be seeing some of these changes anyway. Maybe not as dramatic, obviously, as the COVID impact. But look at how fascinating this is. Well, hang on. Let's go back a couple. Median price, 231. This peaked in 06, right? And then started to head down. Look at percent of original. This peaked in 04 and started to head down. This is a leading indicator, right? So look, this was already kind of heading down from 18 into 19, perhaps suggesting some weakness, at least in terms of that ratio of sold to list price. So I find that one so fascinating, again, in its ability to be a front runner, be a leading indicator for other changes that we're seeing. Yeah, current, we've been at 100%. I'm not going to spend time on that. Right, taking a look at inventory. We once had 36,000 active listings on the market. We now have about 10,000. Month supply, used to have 11 months. You can see 4 months up to 11, back down to 2 months now. I also have year to date. I don't know that we'll spend all of our time here, but just know that, May is just 1 month, right? It's roughly 1/12 of the year. In fact, it's exactly 1/12 of the year. But May year to date, we're almost half the year now. We're almost at 6 months, so we can almost have half of the year. So, I think we saw a 24% decline in seller activity for May alone, but for the year so far, we're only down about 5%. So should we see increases in the second half of this year? Not a guarantee that'll happen, but should we, we may end this year with only, down 7 or down 5 or down 3. Or if we really see sellers kind of ramp up, I suppose we could be break even or even up a little bit. So, keep an eye on year to date as well. It's a little bit of a broader picture. Pendings, a little bit of a pie in the sky back here in 05. Here again, guys, we can see weakness for some time. I don't even know if I'd call it weakness. I think this is just because of the supply picture. There's just no inventory, so it's really hard to write offers. But again, when we see declines this year, well, we have been seeing some declines for the previous years on a year-to-date basis for signed contracts. Closings, similar, won't spend a lot of time. Year-to-date, cumulative days on market, 24. Why? Well, we've had some Januaries and Februaries in the year-to-date period. Homes take longer versus May, where we saw, 16 days. Yeah, year-to-date original, nothing too interesting there. Year-to-date median, so this is actually keeping up. Well, more so, 5.8, 5.6. So about 5.5, pretty consistent. PPSF, about $155 per foot. I don't care how many feet you have, 800 or 8,000 or anywhere in between. We're asking how much does 1 square foot cost? So here again, guys, pretty interesting. Look at the year-to-date number. We're actually showing a gain this year, which I think may surprise some people. But, Jan, Feb, and the first half of March did not look like April and May. So we still see we're hanging on to a little bit of a gain there. Year-to-date, flat at 100%. Nothing that interesting there. Okay, let's do another time check. We are at 2:55. So let's do a double check on any questions. Okay, just for Leanne. Let's take a look at Farmington. Let's see. Let's not do this. Let's actually do our, let's do our trend line here. Let's do our max. Obviously, in a city like Farmington, you'll see much more volatility compared to the metro as a whole, where we see our seasonality for the metro pretty steady versus Farmington, which is, pretty volatile. Well, why? There's not nearly as many closed sales, right? 42. Farmington's wonderful, but it obviously doesn't have the closed sales volume that we have in the entire metro. I'll take things that are intuitive, Alex, for 800. So there's Farmington. I don't know, let's throw in, I suppose as long as we're down there, let's throw in a Rosemount, do some interesting analysis there in Dakota County. So obviously closed sales, the Twin Cities region is gonna completely dwarf these two cities. So let's look at days on market, maybe a better indicator, 16, 20, 15. So pretty consistent. How about absorption rates? 2 months in the metro, 1.5 in Farmington. So Farmington is a tighter market than the metro. And then Rosemount, 2.3, technically a little bit of a looser market than Twin Cities. So I suppose not as strong of a seller's market, perhaps we should say. One of our more interesting indicators these days, how about percent of original? All three, 100%, 100%. Look at Farmington, guys, actually got to 100.8. I suppose as long as we're doing that, we might as well throw in a St. Louis Park. I know that one, I know St. Louis Park really went well above 100%. Let's get out of new construction. Let's shut these two down. Oh yeah, I suppose not that much, not as much as I thought. So only about 100.7 for St. Louis Park. All right, let's do one or two more, and then we will call it a day until next time. Let's see. Let's do a bedroom. Let's do a bedroom breakout. All 400%. How about sold price? Obviously, 4-bedroom homes cost more. So 363, but not up much. 3 beds, 275, only up 2.25. 2 beds, likely some competition here driving prices up, 220. And then 1 bed or fewer. Again, a really tight market, guys. There's just not that much activity there. So down about 5%. Days on market, I would expect that sweet spot to be selling the fastest. Probably 2 or 3 bedroom homes are going to be selling the fastest. Looks like our server has to do a little thinking here. This will be our last one. 28 days for 1-bed homes. Maybe we can sing 99 bottles of beer on the wall. Hey, yeah, we were kind of right, I suppose. 15 for that 3-bedroom product right there. You guys can do something similar with square footages, see if larger homes, kind of see the trend there. Here's your sweet spot, 14 days for 1,700, 1,800 square foot homes there. You can take a look at, you can take a look at percentage of original there. Looks like the biggest homes having to make some concessions, not a surprise there. So you guys can keep playing with this, as I know most of you do, but just know there's a ton of options. And I want to mention one last thing, price ranges, custom. Not everyone knows that you can customize those. So you can filter down to a price range. You can break out all price ranges, or you can customize your price ranges. So just know that you guys can do that. And with that, we will call it a day with 1 minute to spare. How do you like that? I want to say again, thank you to our sponsors. I want to put up their slide again. Want to say thank you again to our sponsors, Bell Bank Mortgage, North Star, Royal Credit Union, and Supra. I want to thank all of you for attending this week's COVID market update. And just know, as I think most of you know, we do have a recording of the webinar on our website on the COVID page. I encourage you all to join us again next week for all the latest, freshest stats. Do check out our website. You guys saw our May reports are up, so check out mplsrealtor.com. And a shout out to my colleague, Eric Myers. If you guys are interested in the policy and what's happening at the federal, state, and local level in terms of policy, PPP, small business loans, all that stuff, try to join him Mondays at 1. He really does a great job with that. And with that, have a wonderful day, everybody.
Thank you, David.
You got it.